Oh, the housing market has seen better days. What will it take to jumpstart sales in earnest? We'll inspect the West Michigan market and close the deal with our guest on West Michigan Week. And on our panel, as always, Carol Village, Grand Rapids Business Journal. Staying cool?
No, it is.
We're all trying. But we have a couple of cool customers here as our guests. We have Julie Rietberg, who's the CEO of the Grand Rapids Association of Realtors, and Chip Cummings. He's a mortgage lending expert and an author. We won't let this go. Foreclosure Myths, and your other book is Cashing In on Pre-Foreclosures and Short Sales. I would imagine these books are doing fairly well under the current conditions.
Sad but true.
Well, the two of you have been in this business for a long time. This is probably a slump like we have never seen before. Where have we been? I don't want to dwell on this too much, but what got us here, in your estimation?
Well, you want to go first?
Well, yes, being in the lending arena, I guess I probably she's going to toss that one to me. Well, as Julie knows, we go back years and years and have seen this market go through a roller coaster cycle. And cycles are always inherent in any market. This one is just much bigger and longer and deeper than anything that we've seen. And a lot of that has to do with some of the lending practices, of course, that we saw years ago, which sort of started this whole snowball rolling. And now we're seeing the pendulum swing the other way. Lending has gotten much tighter, and for many people actually that are even well qualified for homes today, getting the mortgages themselves has become much more difficult. And that's certainly keeping the numbers down, much lower than I'm sure Julie and the rest of the members would like. So that really is what started it. And it'll swing back. It's just a matter of when.
It was those Wall Street fat cats, right?
No, I can't necessarily comment on that.
But there is some of that truth. I mean, a lot of these mortgages were packaged up. There were some bad deals in the first place that got mixed in.
B paper, big incentive though on the sale because you're making more money in interest when you sell B paper.
Well, it was, and there was a variety, all the way down to CD and E paper if you want to go that far. There were investors that were buying this paper on Wall Street, a variety of them, not just the banks and institutional
Bigger
banks.
risk, making more money on
there
those
is, yeah.
deals.
There's always an interest rate. If you're willing to take that interest rate and take the risk, somebody's going to give you the money. And right now, of course, that's been erased. But we're starting to see a little bit of that come back in some of the private banking institutions that have sprung up in the last 6 months to a year. Some of it's coming back.
And in this market, let's show a graphic real quick. These are the average prices. Go back 5 years, wow, you sell then, right? Sell high. I mean, look at that. We're looking at 163 there, and then you see this drop, precipitous drop. There is a little blip there towards the end. 2010, we see that number up, and I'm going to guess that had a lot to do with that tax credit that the government was handing out. And then we're down a little bit, but Julie, you say there is some good news that the prices are coming up.
I think the graphic you have there is our sales through April. May and June have seen some significant comebacks as well, and our average year to date through June is actually closer to 120,000. So it's returning quickly. The good thing about the market today is since in the last couple of months especially, we've seen a whole lot more return to the old-fashioned values for buying a home, as opposed to I can get that great deal because it's in foreclosure, or I'm going to invest. We see more of them going to move up because my family is growing. I feel stable in my job and we're going to make some changes. Those old-fashioned fundamental reasons for wanting to own a home are back. And though it was painful, the whole financing issue, very painful, it was necessary in order for us to get on track. Quite frankly, we were speeding up too fast in the real estate market for it to really continue at that pace or stay healthy at that kind of a pace.
Do either of you have an idea of what percentage of the total market might have been bundled in that way by investment buyers?
You'd have a better idea, but I know it was, at one point it was like 50% was
50% of what was
foreclosures
being
and
sold
short
was-
sales and distressed properties.
Yeah, today, roughly of the inventory that's available on the market today, there's roughly 15 to 18% of those are what we call distressed properties. They're either in foreclosure or short sales. Yet those transactions make up roughly between 45 and 50% of the actual sales. That number is beginning to diminish as well. We were as high at one time as 60-some% of the transactions were distressed sales. So that number is now dipping back down.
You know,
into
when
that
you think about
40%.
the time period, it's only been, what, a year or 2 years since, you know, the major crash. So I would think that that shows some stamina in terms of the market and recovery. Does that seem like a long recovery to you? I guess maybe in terms of history, perhaps, but
Yeah, I think our
given what
I think our
happened.
market turn started probably more like 4 years ago,
Yeah, I'd agree with that.
4 or 5 years ago even. We saw, I think 2006 was kind of the end of our continuous
The run,
up.
yeah.
The climb.
Yeah.
It was a good climb.
And
but,
vacancies, where are those now?
vacancies typically relate to the foreclosures. So, you know, the thing we don't necessarily know sitting at this table is what we call the shadow inventory.
Right.
And
We
you
were
know,
talking
Yeah,
about that
we
earlier,
were,
in that while the numbers, they may seem like they're getting better, that's the unknown.
Right.
And there's a lot of what they call shadow inventory. And for the viewers out there that aren't familiar with that, that's inventory that's sitting there idle, that's not been put on the market yet, held either by financial institutions or the agencies like Fannie Mae, Freddie Mac, et cetera. If all that were to hit the market at the same time, it not only would it skew the numbers, it would be disastrous for anyone else trying to sell their home. I mean, with that competition, it would bring prices down dramatically. So that's going to have to occur over time.
But you're seeing an inventory drop too, which you would say, well, that's a good thing, right? Fewer homes on the market. But a lot of that are some people who have either pulled out of the market or are kind of riding the fence. I mean,
well, regardless of the reason, I think probably the most important statistic we watch is that number of months of inventory.
and it's down.
And
It's
it's
been
down.
going
we
down.
were as high, and our average in '08 was 13.3 months of inventory. And again, for the viewer who doesn't know what that is, if you take the snapshot, so freeze everything at this moment, and say if everything on the market were to sell at the pace of sales in this past month, how long would it take us to sell everything on the market? We were as high, I mean, our average was 13.3, yet we were as high as 16, 17, 18, some 20 months of inventory. A good stable, what I'd call the norm market, is like a 5 to 6 month inventory of properties. And we're right in that 6.4 months of inventory right now. So it's down considerably over what it was in certainly '08, '09.
And that's a lot better than some of the national numbers. You know, I work
Absolutely.
on more of a national basis. There are some markets that are looking at 24, 27, 28 months worth of inventory right now, and we're as high as over 32
Some
months.
markets in Michigan, are you making comparisons in Michigan?
No.
No?
Well, the east side is having a rough time, but some of the more distressed markets include some markets in California, Las Vegas,
Florida.
some of those, Florida.
Speaking of those markets in particular, I've seen reported of foreign investment groups, you know, really looking at land and purchasing those residential properties as well as commercial. But are you seeing any of that kind of activity in this county?
Interesting you bring that up. We just organized through the association an international task force looking at the whole issue of international investment, whether it's for people moving here internationally or for investment purposes here. We're just kind of on the tip of the iceberg on that.
We'll
We've
have
organized
something
a
new to
council.
report
yes.
then.
Yes. It's something we've kind of studied the issue over the last 6 months or so and have realized that that's something that we need to take a more active role in and know a little bit more about.
In some areas, there is a lot of that. Detroit has seen a marked increase in that. Chicago is another market, a lot of foreign investment, and in the southwest part of the country, Arizona, Phoenix market, and again Las Vegas, you've seen a lot of foreign investment come in.
interesting.
How does this market shake out if you compare it nationally? Because you'll get those monthly reports, and they're focused on some of the larger metros, and I think sometimes that can scare people a little bit because truly this market is quite different than a lot of those.
It is. I'm encouraged by the numbers Julie's bringing. You know, we've been sweating the last couple of years when these things come out, but comparatively speaking, West Michigan's in a pretty good spot, I think. I don't know if you'd agree that compared, at least in some of the markets that you look at, especially in the East.
Yeah, I would agree, and it's difficult when we talk about Michigan, and nationally they always talk about Michigan as a whole. If you separate, and I'm sorry to do that, but if you separate east from west, there's a big difference in our recovery, or even how far we dipped in the downturn compared to the east side and our recovery. It wasn't nearly as dramatic. So unfortunately, Michigan is put into the bank of states in comparison, and West Michigan isn't separated from that. So if you compare West Michigan nationally as opposed to comparing Michigan nationally, we fare far better in West Michigan than we do as an entire state. We have kind of followed the trend to a certain extent. I will say that Michigan probably dipped a little bit lower in the downturn than the average nationwide. We were probably, I think, fifth state in the country in terms of the number of foreclosures and distressed properties. But again, as Michigan, that's counting so many on the east side of the state. And that affects us in some ways, but I think people in West Michigan are aware that we're kind of our own unique location
and
here.
beyond the numbers, it's also the mood and the climate out there, which I've noticed has gotten a lot better, at least in the last 6-9 months. As you walk the beat, so to speak, and listen to people on the streets, there's not that, doom and gloom kind of stuff that we saw a year or 2 years ago. So that goes beyond the numbers. It's an upbeat feeling out there, and that'll translate to even better numbers in the
Consumer
future.
confidence, though, numbers are starting to decline again. I'm sure everyone's waiting for the back-to-school sales to show, but that's totally opposite of what you say you're hearing. Are you both agreed on that? Do you think consumer confidence in this region is better than it is reflected
I think you got to separate
nationally?
it out. You know, when you look at consumer confidence, you have to break that out into, you have housing, and then you have other economic areas. And consumer goods, for an example, people may not feel as confident when it comes to spending things on big ticket items, TVs, electronics, vehicles, that kind of thing. But housing, standing on its own, I think if you were to ask that question, would be much more positive.
I do want to come back to that.
When we come back in 1 minute, we'll see you then. And we're back with more West Michigan Week, and I know Carol can't wait to ask the question about new housing starts. Go ahead.
Well, you certainly hear the economists say that every recovery has been led by new home sales, housing starts, and we're not seeing that kind of activity almost anywhere, but especially not in this region. The Associated Building Contractors Association, there are a lot of people who are still waiting for that to happen, that piece to come back. Are you aware of some developments that may improve that situation, or do you think it better than I'm describing?
Probably
No.
a combination of things. I have the reports I've received from the Home and Building Association is that starts are up compared to a year, 2, 3 ago. Are they up a lot? Probably not, but keep in mind that goes, again, back to that same stat, the average months of inventory. The more inventory that exists in the existing market, the more likely someone's going to find something at a more reasonable cost than they are building from start. They can afford to buy something and fix it up to their dreams and still pay less than perhaps building from scratch. As that number of months of inventory continues to reduce, you will see more new home building. There are a number of our members who are specialists in that upper price range, and I'm going to call that 700 or so and above, who will tell us that they have a shortage of inventory in that price range and that they expect to see more building in that custom range.
That would be
at the upper
indicative
level.
of the economy and the massive change that we're seeing in terms of creative class and professional services and the growth in those particular jobs. So let me ask you about household income, because that has not gone up terrifically in this area either. And so that must be a concern. That would delay the recovery you're talking about.
Well, household income, if you compare, even if household income has remained even or level over the past 5 years, they're still in a better position because the average sale price today, now this is on average, every neighborhood is different, please don't be a homeowner that quotes me on this number, but in many cases we are looking on average at sale prices that are equivalent to what they were in 1997. So if you're making more than you were in 1997 from an income standpoint, you're still better
housing
off.
deal.
Well, and also
in
on the
your housing
financing
deal.
side, because the interest rates are so low,
Exactly, yeah.
lower than they were in 1997, so you can get more for your money.
You think that's going to continue to?
Well, I certainly hope so. I think that to lead the recovery, you're going to have to see the free flow of money, and people are going to have to be able to get access to funds at that rate.
I mean, it seems like the stumbling blocks, and you've mentioned a couple, but why don't we just pile on here? You know, the employment situation, people do want to move, they can't, they're anchored to a home, and you know, people I think want to take advantage of those interest rates, but the financing regulations have shifted.
Well, that's the thing. Yeah, our world has changed a lot. Financing has completely changed in the last couple of years. It's much more difficult. We don't do some of the deals like we were talking about, at least the 100% down kind of things. FHA is still the best game in town at 3.5% down getting into a home, but there are some limitations there as far as dollar amounts. The people that are in the upper dollar amounts, as Julie was saying, they're not as affected by the economic climate. You know, housing starts in that arena, good, bad, whatever, they're still going to be there and be able to do that. But the one concern that we have in terms of the credit market, so to speak, is because of the way the markets have been constrained, we don't have those kind of programs available to get people into homes. And so you can have all the inventory you want, you can even have people employed. If we can't get them the money, then it's not going to move, and that's the problem.
I guess I have two questions that come to mind, you know, in this regard. First, the higher income, well-educated, more affluent individuals moving in and who do live here in the county area. The Van Andel Institute, the hospitals, the physician recruitment in specialty areas, all of that is bringing a lot of new residents into this community, and the higher income that you're talking about, where you're seeing no problem in sales or confidence. It was my understanding that most of them wouldn't be living downtown, would prefer urban living. And have you found that to be true, or is that new professional coming into Grand Rapids is likely to be in Rockford or Byron Center?
I don't know that I'm in a position
That
of
you've seen
actually
the
answering that.
demographics,
No,
huh?
I don't really know the demographics of that. We'd have to talk to a
I
few of
don't
our
either.
members
Yeah,
in that range.
there's a few other people that we probably have to consult with to see where they're actually going. I can tell you from an overall standpoint, the people that are coming in for those jobs, and they're good quality jobs, and they're certainly making good money. I think that some of the trends that you've seen in other big cities are certainly the case here.
Reflecting.
Going into downtown areas that are being redone, I think people like that type of the city living, so to speak. But there are also people that are liking areas like Rockford and Ada Cascade that are migrating down to that area. Public transportation has a lot to do with that as well, for the support jobs for those positions, and can they get effectively to those jobs.
Yeah,
so
good point.
that plays into it well. And Grand Rapids stacks up very well when you look at it on a national scale compared to other cities.
Well, we can talk about the condo market. We had a boom of condominiums, and I think some of the other projects have wrapped up. I don't know if there are any new ones on the horizon, but that market in and of itself, are there a high number of vacancies? I mean, I know the icon on bond is now essentially apartments at this point. What is taking place in that market? Is there a high number of availabilities at this point?
I think the percentage of availability there is not unlike the housing market. We've seen that decrease as well. We actually have seen a lot of people invest in some of those condos because they think that's where the future is going to be, and the prices were reasonable to such an extent that they've actually purchased and are now renting those condos to others. So the vacancies are much less in the condo arena downtown than they used to be.
Certainly, some of the expectation to fill the condos downtown were the empty nesters. And after what they've been through, that boomer population, nationally, they're looking at renting. They're not going to. They won't own property again. It's partly a fear factor, I would think. But is that also true in this market?
We've actually, it was a note I made in our discussion here that I wanted to make sure to mention the whole rental side of things. You know, we for so long have been designated as a sales organization, and our members deal with the sale of real estate. We have geared a whole lot of effort and programming and time into the rental side of things because we recognize that more and more people are renting versus buying, especially if they've been through a foreclosure and can't get the financing that Jim was referring to. They have to live somewhere. Many are used to living in a house and have a family of a size that they really don't want to have to live in an apartment, something smaller. So we've geared up for the rental side of things. We're running educational programs and otherwise on the whole rental side of selling, landlording, leasing, et cetera. So that's a whole new element to our market.
That's interesting too, Julie. Now we have 2 news stories to follow up on.
Yeah.
Well, that's very important what she says, because the investors are going to have to bring the market back. They're the ones. Because from a financing perspective, we've got to have typically a 2-year history that's pretty solid. And people that have gone through even minor credit problems are going to find it difficult to get into that financing scenario unless they've rented for 2 years.
Well, at what point does the box break open in terms of how you look at creditworthiness? I don't know that box has ever changed. Some of the same things are asked now that were asked in my parents' time. Does this create a situation where you would ask different kinds of questions to determine, some history, the full history, particularly with older buyers?
Yeah, it would. The box may be the same, but it's gotten smaller. Before, if you had a credit score of over 800, you could just walk in and set your own terms and be financed. Now, even though you've got a credit score of 800, we're still going to look at the employment situation, and if you've got income coming in, great. But for people that were self-employed, you could get financing a few years ago where you can't now. I had a client that just had a customer a few months ago, had a lot of money in the bank, great history from a self-employment standpoint, but couldn't get the financing set up because we couldn't prove a monthly income on a W-2 basis. It was a silly thing. From a common sense standpoint, we should have given him the money, closed the deal, and moved on. But those kind of deals are much more difficult to get approved nowadays.
So does that mean those kinds of things would then become a part of that process? Is there any willingness especially with financial institutions, to open that door a little bit?
Well, as much as they can.
As much as they can.
Yes, Congress
They've
got their
been through a
hands
lot.
I know
tied
that.
right now.
I was afraid to bring that up
well,
because we'd be here for another hour.
From a private sector, it will. A statistic I saw not long ago indicated that as much as 95% of all mortgages right now are backed or guaranteed or somehow endorsed by the government. And we've got to get that number much lower. Private banking institutions now are starting to put together not necessarily mortgage-backed securities like we saw in the last couple of years, but private consortiums where they say, look, we know that there are good people out there, there's good risk, a decent interest rate of 7-8% still gives them a good return, we'll loan that money on a short-term basis, and they're filling that gap. And we'll start seeing more of that in the marketplace.
If we've become an entrepreneurial society, and as the push continues with GVSU being one of those schools, offering a whole center for entrepreneurs. You know, the grid downtown, those types of developments. If we truly want that kind of small business investment, what you're saying is a big deterrent.
Well, I look at it as an opportunity. You know, anytime you get a problem, there's going to be somebody that comes in and tries to figure out a way to solve that. I think the market will figure out ways of creatively solving that problem, because people will still want homes. You know, I was speaking at an event in California recently, and they said, are you going to pay cash for the home? The answer is no. So financing will always be there.
All right, financing will always be there.
In one way or another.
That's right.
Carol Valade, thank you for being here. Julie Rieperg, CEO of the Grand Rapids Association of Realtors, thank you.
Thank you.
And Chip Cummings, author, mortgage lending expert, thank you so much.
You bet.
And thank you for joining us this week. We'll see you next week on West Michigan Week.